Is the idea of a mortgage payment with a 6 or 7% rate keeping you out of the market? Well, I've got some good news and some slightly rare information that not a lot of people talk about. And that is a way to get as low as a 2.25% rate, maybe a 2.5, 2.75, all the way up into the threes and fours, based on A, what you can qualify for, and B, what home specifically you're looking at. Not what type of home, but the actual specific home and the owner of that home currently. And what I'm talking about here is assumable mortgages. Now, there's a lot of people that have heard the word assumable mortgage and they go, no, it's not really a thing. I can't get one of those. Some people that I've talked to go, wasn't that something from back in like the 80s or 90s? And well, yes. However, it's still today. So a little known fact is that every FHA mortgage and every VA mortgage is actually assumable. Now, FHA makes it a little bit easier because, well, anybody can qualify. Now, when it comes to VA, I know what you're thinking, oh, I have to be a veteran in order to qualify. Well, the fact of the matter is you actually don't need to be a veteran. You could actually be an investor, you could be a regular civilian, and you could actually qualify to assume a VA mortgage. The reason that the Veterans Administration did that is because they want to be able to help their veterans out of a situation where that veteran maybe needs to actually move and they are kind of stuck into that home because people aren't buying it at the price that they want to buy it because of current interest rates. So as a result, they allow other people to actually assume it. Now, there is a caveat. If you are a civilian or an investor and you're trying to assume a veteran's mortgage, whatever entitlement they had with the VA might be completely wiped out or a big portion of it wiped out. Now, you might be saying, I don't know what that is. What's an entitlement? Well, the Veterans Administration has something called an entitlement where they have a loan value that they will loan up to. And it's based on the number of years, the type of service, what rank that person was in the military, and a few other factors. So some veterans may say have an entitlement of up to $500,000. Others might have up to $800,000. There are entitlements that vary based on geography. And then there are also unlimited entitlements as well. Let's say you had a veteran that had a $600,000 entitlement and you're purchasing a property and you're going to assume their $250,000 portion of the loan. Well, then in that case, they actually still have $350,000 left in entitlement. All that said, in a lot of cases, it's not very prudent for that veteran to give up that entitlement unless they're not planning on buying another home. Maybe they're a bit elderly and they're going to move in with loved ones. Maybe they're moving into an active adult facility, or for whatever reason, again, they have zero intention on actually getting another VA loan. And then in that case, they could go ahead and sell it. Now, why would they sell it and let you assume it? Well, because they can maximize the actual purchase price. Because if you look at it and you say, look, I'm going to look at this house, that's a $600,000 house, and I could assume the remaining $500,000 of the mortgage at 3%. Or I could buy the house and I have to get a mortgage that's going to be 6.75% today. Well, that difference in the payment might either wipe you out from getting that $600,000 house, which now reduces the buyer pool, or maybe it puts you in a position where you want a nice discount or you want some seller concessions like some closing costs to pay down the rate. So in that case, this veteran may be able to actually get $600,000 for the house the way that it is versus getting $600,000 and giving, $25,000 back in closing cost concessions and, other things, or maybe even taking less for the house. So that's why that would be. Now, as it turns out, government-backed loans from FHA, VA, and USDA cover about 27% of loans out there, which means that 27% of the homes are actually on an assumable loan. So now the next factor is, what did they buy that home at? What did they either refinance it at? And what's the balance on the loan? Because here's the next piece is, again, You've got the $600,000 home, there's a $500,000 loan on it, you're paying $600,000. Where does the other $100,000 come from? Well, that comes from you in a couple different ways. That could be your cash down payment towards the home, or it could be something that you borrow a second mortgage on at closing. So at closing, before it actually closes and you take titled ownership of it, you've got the $500,000 assumption, and you've got this certain amount. It might not be the full $100,000 because typically you're always going to put something down. But let's say you're going to put 5% down, which would be $30,000. You'd have that $70,000 second. So that is an option, though a straight assumable is always going to be easier because you do have to qualify. Now, another great thing is that you don't have the typical closing cost on an assumable. You don't have an appraisal because they already have that loan. They've already appraised it and approved it. You don't have a lot of those normal pieces like the origination fees and what have you. You have an assumption fee, which is typically pretty nominal, of about $1,500. The other thing is that assumables have a lot of moving pieces, and the lender, the investor that actually is behind that loan, well, they're not making money on that assumption. They're just going to continue collecting money, and at a lower rate than they could collect today. It might even be a smaller margin or a smaller spread than what they could do today. So their incentive is not very high. So a lot of times we've heard that assumables can take 4 or 5 months to get done, which is why it's really prudent to actually have an assumption manager. Most assumption managers are going to charge about 1% of the purchase price of the home. So that would be about $6,000, which, mind you, is dramatically lower than what a new loan would actually cost. So not only would a new loan have a much higher interest rate, but that new loan would also have origination fees, discount points, underwriting fees, processing fees, so on and so forth. And that loan oftentimes is going to cost $9,000, $10,000, maybe even $11,000 to originate, versus now if you've got an assumption manager staying on top of it, you're not only paying a lot less in just paying that 1%, but you're also going to really shorten that timeline. So that assumption, instead of taking upwards of 3, 4, 5 months, is now going to be a 30 to 45 day, possibly 60 at a wide range push in order to do that. If you have questions about assumable loans, about assumptions, about who the right people are to get in your corner when it comes to assumption managers, that is not me, but I do know of some. But if this is something you're looking for, there is a way to identify the homes. There is a way to understand the economics, the mathematics behind it, to understand where that down payment is going to come from, and to understand how you could score a deal that's going to benefit you and also benefit that seller. Again, you're going to likely pay a little bit more, not overvalue, but you're going to pay at list price. However, the amount of savings that you're going to have in the interest payments alone are going to be astonishing. So it is a great option that not many people are leveraging. Not many agents really know the ins and outs of it. Not many mortgage lenders know it, and it doesn't behoove the mortgage lender because now they're going to lose the opportunity for a loan. So, ultimately, and it's not in a bad way, but, it's just something that they don't necessarily all dive into and get that knowledge on. If this is something that might be of interest to you, if you've been on the sidelines or on the fence of whether you should move forward or not because you've been staring down the barrel of a 6.5 or 7% rate and that scares the heck out of you, then reach out to me, message me below. Happy to answer any questions that you may have to the best of my ability. If it's an answer that I don't know, I will let you know that in the comments or when I speak to you, and I will do my best to dig as deep as possible to get that question answered. So feel free to reach out to me. I would love to hear from you. I would love to talk to you more about these opportunities, whether you're ready right now or even thinking a year, 2 years down the road. There's still maybe rates that were a lot better than we're ever going to see again in our lifetime. So these opportunities aren't just today. They're today and well into the future. All right. Hope this helps and gives you some more information that maybe you didn't have before, and we'll see you on the next one.